The Bank of Canada hikes interest rates yet again, and they say more is to come. Hi, I'm Brian Lilley, political columnist with the Toronto Sun. It's a bit of a wrecking ball the way the Bank of Canada is going into the market and hiking interest rates. Yes, something had to be done about inflation, but as I'll explain in a minute, the Trudeau government could be helping by reining in spending. They've refused to do that, leaving everything up to the Bank of Canada. So on Wednesday morning, the Bank of Canada increased their overnight lending rate from 2.5% to 3.25%. That's a 75 basis point jump. And they say expect more in the coming months. Now, all of this is going to lead to higher interest rates for people with variable rate mortgages, lines of credit, be it a personal or business line of credit. It's going to put the cost of borrowing up across the board. And for people who aren't on variable rate mortgages but are about to renew, things are going to get a lot more expensive. The folks over at lowestrates.ca looked at what this will mean in terms of monthly mortgage payments for someone on a variable rate mortgage in some of the country's biggest cities. Let me run down this for you. It's not pretty. Looking in Toronto, where they peg the average home price at being just over $1 million, well, going from a 3.7% monthly mortgage rate to a 4.5% will mean a $351 per month increase on that average home. In Vancouver, it's a $394 per month increase for their average home. In Calgary, $194 a month. In Edmonton, $146 per month. And in Halifax, $150 per month. That's without anything changing. Now, if you signed up for a fixed rate mortgage back in 2018, let's say, and it's coming up for renewal, well, then you're going to be in for one heck of a shock because mortgage rates have gone up dramatically while you have been paying a much lower rate. Many people will either be forced out of their homes or not be able to get into the market. We all know that for many young Canadians, getting into the housing market has been difficult already. It's a major part of the affordability crunch. Now, as I said, the Bank of Canada had to do something about soaring inflation, the cost of living getting out of control. But now their actions are adding to it by pricing people out of the housing market. Months ago, a top economist began warning the Trudeau government that they needed to do something about out of control government spending to rein it in. I'm not talking about the COVID spending, but the overall growth in spending in order to make sure that it wasn't all put on the Bank of Canada and homeowners to suffer the blunt of what they were going to do on mortgage rates. Now, Chrystia Freeland, the Deputy Prime Minister and Finance Minister, giggled when asked about this and said, "We've done our part already." No, they haven't, and they're not going to, and that means lots more pain for you. Doesn't mean more pain for Justin Trudeau or Chrystia Freeland. They are well off. They are in a good position. But for the average Canadian, things are going to continue to bite. A note from the top economist at TD Bank shows that we are moving from inflation being driven primarily by factors outside of our borders to domestic factors driving inflation, and we can expect it to continue through 2023. None of this is good news, and the worst part is the Trudeau government has no plan to fix it. Let me know what you think. Drop a comment down below, share this on social media, and don't forget to subscribe to our channel.